Okay, so the accounting cycle, okay? We've now done most of this. Okay, so before I talk about the chapter 4 topic on this, let's just uh, make sure we're very clear on what we've been doing up till now. Okay, so the first step of the accounting cycle is the start of the period. Okay, so at the start of the period, you're going to have account balances. You're going to have cash. You're going to have your property, plant, and equipment. You're going to have your liabilities. You're going to have all the retained earnings from all the previous periods. Okay, so you're going to have starting balances. And we're going to learn what these are the permanent accounts. So for permanent accounts, the accounts that don't have balances at the start of your period, revenues, expenses, and dividends. Because now we want to start tracking during our accounting period, what were our revenues, what were our expenses, how much did we pay out in dividends? Okay, but so those are going to start at zero at the start of the period. Then there's going to be transactions. So during the period, we have all those transactions that occur, right? We're going to buy more property, plant, and equipment assets. So we're going to trade assets for one another. We're going to have revenue. We're going to pay expenses. Uh, we're going to have all the different things that happen to our business during the period of time. So the period of time, it could be 3 months, right? If we're reporting our financial statements every quarter. It could be every 1 month if we do monthly financial statements. It could be 12 months if we do yearly. So whatever transactions are happening within this period of time that we care about to measure, we're going to be tracking those. Okay, and we're going to be doing journal entries for those. So that was chapter 2. This is essentially what we did in chapter 2. Journal entries for transactions. So what we did is we made the journal entry and then we updated the accounts by posting them, right? We had those T accounts. Whenever there was a journal entry, we'd make the journal entry and then update the account balances during the period. And we just kept accumulating those during the period. So now at the end of the period, for like cash, for example, we have a bunch of things that happen. We have debits and credits to cash. We're going to have some balance here, and that's going to be included in our unadjusted trial balance. And we're going to do that for all of our accounts, right? We're going to compile all of our ending balances as of the end of the period and put it into this unadjusted trial balance. Okay. Then what we just did in chapter 3, we know that there are certain things that we need to account for at the end of the period because there's no transaction that's per se happened, right? So we had depreciation as time has gone by. We had prepaid assets like insurance that, again, time has gone by. Interest expense. We had some accruals like salaries payable where the cash is going to be transacted later, right? So we needed to basically do all these adjusting entries to account for all of our deferrals and accruals. Deferrals and accruals. Okay? So this was chapter 3. This is again chapter 3. And we got here. This is chapter 3. Adjusting entries. Okay? So with this adjusted trial balance, we now have our updated balances for all of our accounts. We can then use those balances and convert them into these reports. Right? These are our financial statements. The financial statements are not changing anything in our accounting system. We're taking the information which is presented as debits and credits in our accounting system, and we're taking those numbers and we're putting them into these reports. Okay, again, we looked at these financial statements. There's no mention of debit or credit there, right? We're just those numbers are coming from the accounting system, and the company has arranged them into these reports. Okay, so the information system's output of debits and credits and the balances are used to make these financial statements. Yeah, I mean, it's in a real company, the retained earnings is just one column in the statement of equity because they'll show how much contributed capital came in, what the retained earnings was. They're going to show all the equity accounts together in one statement. They won't just have a separate one for retained earnings. Yeah. Actually, let's see. That might be useful to see, just to be clear. Okay, so this is the statement of equity for Berkshire Hathaway. You can see retained earnings is one of the columns. So if you look here, balance as of the previous year. So if we track this balance, it's here. They're going to add net income right here. This is some accounting change. They do not pay a dividend, and so they updated the retained earnings. So it's just one column. They also, if you look at common stock, so this is contributed capital. So they have, this is a starting balance. There is some contributed capital that happened with one of their subsidiaries, and then they updated this. Okay, and then treasury stock. So they do stock buybacks. You can see that they had some stocks that they had repurchased. They did some more repurchasing here, and they're basically updating every part of the equity. Yeah, and of which retained earnings is just one of them. But it's the same process: beginning balance, plus your additions, minus your subtractions, ending balance. So now we're basically coming to chapter 4. Okay, after we've made our financial statements, we're going to kind of reset the books for the next period. Okay, and what that means is taking the revenue, expense, and dividend accounts and zeroing them out and moving that information into retained earnings. Okay, and we'll see how to do that. It's going to be achieved through these closing entries. These are actual journal entries that will change balances. Okay, again, these financial statements, when we make them, aren't changing any balances. We're just taking the information from our accounting system and compiling a report. When we do these closing entries, we will actually change the balances. We'll make the revenue 0, we'll make the expenses, all those accounts 0, and we'll make the dividend 0. But we can't just zero it out. We got to move that information somewhere. Okay, so we're going to see how that's achieved. And then once that's kind of achieved, we'll have another trial balance called the post-closing trial balance, which is kind of a trivial thing, and you'll probably never see one in real life because it's not really needed for modern accounting software. But basically, all your temporary accounts are now 0. Revenues, expenses, dividends are all 0, and you can now restart in the next period and just restart this cycle again.